Hi, everyone, and welcome to our interview session with Tim Lawless. Tim is the head and founder of the research division of CoreLogic, previously called RP Data. We know when it comes to property data, CoreLogic is an absolutely unrivaled guru. Tim is a household name in the sector, and undoubtedly, a lot of our followers will be excited to get his insights. Let's say hi to Tim. Tim, thanks so much for your time.
G'day, Shapur, and thank you for inviting me along, mate. It's great to be able to engage with the Persian community through your channel.
Now, from the supply side perspective, are many owners just sitting on their hands, or are they putting their properties in the market? What is the supply trend now?
It's really starting to change. If you'd asked me this question about a year ago, I would have said absolutely. A lot of owners are just simply sitting on their hands. They're not willing to put their property on the marketplace at the moment, despite selling conditions being extraordinary. I think a lot of property owners were either more focused on generating wealth out of owning their home, or they're a bit cautious of selling their home out of fear of not being able to buy back into the market because it was moving so quickly. Now it's very different. We're actually seeing the flow of new listings coming into the market has more than normalized. It's generally above average in most capital cities. The difference, though, is total listings. So you've got two ways of measuring listings. You've got the flow, how many new listings are coming into the market, and that's really high, above average in most cities. But then you've got your total inventory levels, or what you can describe as stock. So you've got flow and then stock, and the stock levels are very different. So go to a market like Brisbane, and we're still seeing the number of homes that are being advertised for sale, the total number of homes, is about 40% below average. It's about 40% below average in Adelaide. It's about 30% below average in Perth. In Melbourne, it's now about 8% above average. Sydney's only about 1.5% below the 5-year average and trending back to what you might describe as normal. So we're definitely seeing vendors more willing to sell. The total stock levels really come back to a rate of absorption. How many buyers are active in the marketplace willing to or ready to absorb that new supply? In Sydney and Melbourne, that rate of absorption has really slowed down, whereas in markets like Brisbane, Adelaide, Perth, that rate of demand is strong enough to keep a really rapid rate of sale and keep overall listings extremely low.
That's great. Thank you. Now, that was the supply side. How about the demand side? What can we learn about the current composition of the demand side?
Well, most of the demand in Australia comes from what you might describe as subsequent owner-occupier buyers. So non-first home buyers, people looking to upgrade or downgrade or moving homes because they've changed jobs or something like that. So that's generally the biggest market. So people buying for owner occupation who aren't first home buyers. And then you've got two other segments of the marketplace. You've got first home buyers and you've got investors. So let's look at the trend for each of those three segments. First home buyers, clearly trending lower in the market. The first home buyers tend to be really responsive to stimulus, and they really surged into the marketplace early in the pandemic, taking advantage of the blend of things like Home Builder together with the first home loan grants, home buyers grants, and a 5% deposit guarantee. That really, gave a lot of first home buyers an ability to access the market, along with more affordable housing stock, say, a year and a half ago as well. Now, first home buyers are really fading in the marketplace. They're about 24% of overall owner-occupier mortgage demand, so a little bit below average now. But investors are really starting to ramp up. We're seeing investors now at about 33% of mortgage demand, so about a third. Long-term average is 35%, so investors are getting back to what you might describe as normal levels. And I think investors will continue to trend higher in the market, taking advantage of better buying conditions, probably the fact that lenders are becoming more I suppose, focused on the investor market as first home buyers fade. And then your non-first home buyer owner-occupiers holding pretty level at the moment. They're by far the biggest segment of the marketplace, but they're not showing much growth anymore. So it looks like they're stabilizing in the level of demand. So if you're looking for growth sectors in the marketplace, it's investors, first home buyers diminishing, non-first home buyers generally holding pretty firm now.
And what do you think is the underlying reason for the fact that the market's now skewed towards investors?
There's a few things. So investors in Australia are generally motivated by capital gains, right? You have investors that are capital gain driven or investors that might be yield driven. And then you've got investors that look for a blend of both, which is probably the healthiest investment philosophy, is to try to locate well in an area that's got a strong rate of capital gain or prospects for, as well as getting some cash flow coming through or a minimum amount of negative gearing. So it really depends on what the investor's strategy is. But I think the fact that we're seeing investors becoming more active now comes back to the fact that we're seeing very tight rental markets. Vacancy rates are generally around the 1% mark, if not lower, in most of the major rental markets. We're seeing rental yields are just starting to repair a little bit now as well. So rental yields are generally quite low in Australia historically, but Sydney and Melbourne are seeing rental yields below 3%, gross yields below 3%. They'll gradually start to recover now as well as rents rise faster than housing values. And then you've also got, I think a lot of investors would appreciate that interest rates are very low. And even though they're going to be rising, they'll probably remain quite low for the next few years at least. So, a lot of factors that I think investors are probably motivated by. But overall, as the housing market slows down in terms of the growth rate, that could gradually become more of a disincentive for investors. But of course, most investors are there for the long term rather than trying to buy and sell in the space of a year or two.
Oh, that sure sounds quite right intuitively, because when the rental market is tight, there's no reason to go for capital growth. I mean, investors who were after capital growth bought a couple of months ago. I see a lot of investors being interested to enter the market, even in this softening market. And the reason is, as you mentioned, definitely, it's not speculation anymore. I don't see much speculation. Those investors that I see buying into the market, they're not after huge amounts of profit in the short term, but they are very happy about the stability, about the security that they can get by having a rental, as you mentioned.
And that's a really good point. The stability of housing compared to, say, the volatility of equities, especially during a lot of global uncertainty, is probably another factor. The housing market is probably seen as a bit of a safe haven during times of uncertainty.
Tim, from what you said, I can infer that you have never bought cryptocurrency, have you?
No.
I know it's there. I hear very contradictory things about mortgage stats and mortgage stress. What do numbers tell us about the odds of the amount of mortgage stress existing leading to distressed sales, forced sales, and crash in the market?
So we haven't seen any numbers on mortgage arrears for a while, simply because lenders had a moratorium on mortgage repayments for quite some time. But my guess is we start to see mortgage arrears numbers being republished. Mortgage arrears, by the way, are simply a proportion of loans that are more than, say, 90 days overdue, right? So generally, that's before the pandemic, at least, that was around about 0.6, 0.5% of all mortgages. And even during through a downturn, you never really see that number getting above the 1% mark. It did in Perth and WA through that extended downturn, and that was through a combination of negative equity in home values along with a fairly weak labour market as well. So as long as we see the labour market remaining as tight as what it is, and probably it will get tighter, in fact, as long as we see the economy holding up and interest rates not normalising back to, say, average levels really quickly, I'm not expecting there's going to be any material level of distress in the Australian housing market. I'd be really surprised if we saw mortgage arrears getting above 1%, for example. So, yeah, it doesn't look to me to be that much of a risk. Household debt is at record highs. Okay, so that's probably important to note. And households are going to be more sensitive to the cost of debt as it rises. It probably means that households will need to dedicate more of their incomes towards servicing their debt rather than spending on things. So probably the outcome there means less discretionary spending from households, more to going towards debt serviceability. It's generally when a borrower gets tested to take on a loan, they are being tested on higher mortgage rates. So 3 percentage points above now, previously 2.5 percentage points. So I think there's a pretty decent buffer zone there. Other stats you see from the RBA is that there's a pretty substantial offset buffer that's been built up by most borrowers as well. The exception there would be for recent home buyers or for first home buyers who simply haven't had time to build up a level of or a financial buffer or a level of equity in their dwelling. So there's definitely some risky elements there, but I think across the board, we're generally seeing across the Australian housing asset class, the overall loan to valuation ratio is around 22, 23%. So it's very low. It looks like a pretty safe asset class to me at the moment.
I mean, as you mentioned, when there is interest rate rise, I mean, cash rate and then variable rates, when there is variable rate rise, we always expect some degree of mortgage stress, but that degree is not significant enough to sort of cause a crash in the market, right?
Yeah, we're not expecting there to be a raft of distressed listings coming on the market or forced sales. Be very surprised if that transpired. If it did, then absolutely that would be a source of additional downwards pressure on housing prices. But I think it's a fairly outside risk.
Tim, how much of a bubble do you see in the property market having formed in the last year or so?
Yeah, I don't think there's a bubble, and it's a term that's used a lot without really thinking about what a bubble means. A bubble generally implies that we've seen this inflation of the asset values, which we have, but it also implies we're going to see a really sharp downturn as the bubble pops. I simply don't think that scenario, that outcome is going to happen. It's going to be, well, if history is anything to go by, we generally see these strong upswings followed by a period of a downturn. We could see Australian housing values fall, say, similar to the last downturn, which is down about 8% to 9% nationally. Maybe something similar to that. But this has been a much shorter and sharper upswing. So potentially we could see that the downturn minimized because of that, along with a fairly strong economy as well. So chances are we'll see this more of a deflation of that bubble, for using that word, rather than a pop. Time will tell. As I said in the last question, I think the economy's in a pretty good position at the moment. If you want a job, you can generally get a job in this economy, which is probably the main factor on keeping distressed or forced sales off the market.
Sure. And to paraphrase what you just mentioned about the concept of bubble, a layman's concept of a bubble is perspective. That is, a layman says prices are increasing sharply, so a bubble is forming. In other words, they expect prices to get corrected significantly in the future. Okay, this is a layman's view, but the professional's view of the bubble is retrospective. There was a huge rise of prices, and then there was correction, so we can conclude there was a bubble. A bubble can never be predicted. Maybe it's just a sharp increase in prices. Is that right?
I think that's a fair enough description. And it's probably also fair to say that a lot of those demand side drivers are now starting to lose some of their potency. They're not quite as strong as they used to be. And for that reason, we're starting to see the rate of growth is already easing across Australian housing markets and starting to see less activity as well.
I mean, one recent podcast I predicted based on data derived from CoreLogic that due to unprecedented huge price difference between houses and apartment units and due to affordability issues, buyers will show a renewed amount of interest in the apartment market. Now, how do you assess the future of loss-making inner city apartment units in Australia?
Yeah, I think the unit market's actually a fairly or reasonable investment at the moment, especially in markets like Brisbane, for example, where that pricing gap you mentioned is much wider. Brisbane's unit market's been soft for quite some time, and it's largely absorbed a lot of the oversupply that's been there. We're also seeing unit rents rising quite quickly now as well. So we are seeing investors probably becoming more attracted to some of those inner city apartment markets simply because rental markets are so tight and they're seeing some pretty decent rental income coming through. It looks like apartment construction remains pretty soft at the moment. We're not seeing the same level of new supply being built as what we are in detached houses as the apartment market. So we're not really seeing those same sort of cautionary notes around oversupply in the unit sector either. So yeah, I think we'll gradually see that pricing gap narrowing across houses and units. More households looking towards the unit sector simply because it's more affordable and it's where they can afford to buy.
Tim, I can continue this interview for good. I genuinely enjoyed the smooth flow and the first-hand data you presented here. I hope to be joined by you again in our future podcast. Thanks indeed for your time.
Thank you, Shapur. It was an absolute pleasure to be involved. Thank you.
Thank you very much.